I always think the risk is that we run out. You build all this capacity for the energy transition and then don't have the basic materials or raw materials to do it.
If you take a 5 or 10 year view, very clearly there's going to be significant new demand for a range of commodities linked with energy transition, and that's a really exciting time and a really exciting opportunity.
So it's just going to make these companies and as these emerging companies come through, really very, very significant in the world stage.
Welcome everybody to day 2, and we're going to enjoy talking about commodities. I'm Clyde Russell. I work for Thomson Reuters as the Asia Commodities columnist, and joining me is David Franklyn, who's the head of funds management at Argonaut, and Barry Dawes, who's the executive chairman of Martin Place Securities. So what you've got up here is a journalist come analyst and 2 investors. And we've got the very broad topic of basically what is going on in commodity markets. So what I'd like to do is sort of start with a few general comments from myself and then from the two other panelists on where we see things, and then just sort of take it from there. With a group like this, feel free to leap in at any time and ask questions. That's what we're here for. And what I was just saying to Barry and David before we started is, it's been a fascinating year in commodities. I think we all know that. But I think the thing that has struck me is that the world changed on February the 24th when Russia invaded Ukraine. Everything we thought was happening up to that point, you could basically forget it, and we moved into a whole new paradigm. And I think you've seen this very obviously in the energy commodities, mainly natural gas, LNG, coal, but also in crude oil. And it hasn't really impacted too much in the metals. What you've actually seen in the metal space is, you've still got the traditional driver of China for things like iron ore and copper, and the worries over the Chinese economy, I think, has probably been more of an influencing factor in metals and what's happened in Russia and Ukraine. But what is going to happen next year, and this is what I think, something that we should talk about, is what is going to happen to those metals next year? Are people going to self-sanction Russian copper, Russian aluminium, Russian nickel? Is the LME going to remove Russian inventories from its warehousing system? All those kind of things are still up in the air. And what you have seen, particularly in the coal and natural gas field, is that a small disruption has a huge impact around the world. I mean, who would have thought? I mean, I've been covering commodities for more than 20 years. The idea that thermal coal rose to a substantial premium over coking coal, that's just simply ridiculous. That's never happened in my lifetime. But that's what's happened now. And you sort of, the idea that things can change so dramatically and so quickly and so irrevocably. I think we need to sort of have a look at that. We also, one of the other topics that we're going to look at is, the energy transition. And I guess, again, I always like to try to separate things into sort of what's the immediate problems, what's the sort of medium-term problems, and what are the long-term problems, or maybe not problems, issues. So I also think, right now we have an energy crisis. This is a short-term thing. This is a tremendous boost for coal, LNG, crude oil right now, right here. But that won't last forever. That problem will be solved. More expensive coal now just means less people will want to use it in the future. And if you talk to people in Bangladesh, the Philippines, places where they're supposed to be building import-based coal-fired power plants, they're walking away from those as fast as they possibly can. So, a good price now probably means a weaker price in the future for certain commodities. And the other thing that we haven't seen yet, and I think this is probably relevant as well, normally when you get a massive price spike, particularly for something like LNG, that looks like it will be sustained for several years. You're going to start to see a lot of money flooding into, boost supply in that area. You haven't seen that. I mean, I'm not seeing a flood of money into new LNG projects. I'm seeing existing ones that are in the pipeline being developed, but I'm not seeing people trying to do new ones. I'm not seeing much money at all going into coal. I think the coal companies are printing, or getting lots of cash, and they're distributing it. They maybe are doing sustaining capital, they may be doing some brownfield expansions, but they're not actually really investing a lot of money into new coal mines. So the money, I also the best piece of advice ever given, probably in human history, was from the Watergate crisis, which was follow the money. And the money, to me, seems to be going very much into renewables. But anyway, I've talked enough. Let's turn it over to David and ask, just a general thing. 2022, what a year! What has been the things that have caught you? What do you see as the major issues in the mining industry right now?
Yeah, thanks, Clyde. That was a good introduction, and I think what it highlights is plenty of uncertainty and plenty of volatility sort of right now. I think if you look on 2022 and really the last 12 months, what's happened is, as an investor, you needed to be in coal, you need to be in oil and gas, or you need to be in lithium, or you didn't perform. And they're quite diverse commodities for different reasons. The point I would make is, it's a time where there's plenty of uncertainty. But it's also a unique time in history, with the energy transition. And I look at it, and the US, China, the EU agree on very few things, but the one thing they do agree on is energy transition. So, the way I look at it is, in the short term, it's difficult to predict what's going to happen. You got the war in Ukraine, and as you were saying, what implications that has on commodity markets is difficult. But if you take a 5 or 10 year view, very clearly there's going to be significant new demand for a range of commodities linked with energy transition, and that's a really exciting time and a really exciting opportunity.
Yeah, I think the short term is always going to be very difficult, especially currently. I think you're right. The idea that renewables is a thing, and it's one thing that the world actually does seem to agree on. What I think is interesting is the idea that we're going to ramp up renewable energy, the energy transition, at the same time as still needing fossil fuels, but ramping them down. And it seems to me that the main problem with this is the timing. Yeah. If you go to an oil and gas event, those guys are like, we're still needed, we need money, you're going to need us for the next 20 years, and they're not getting it.
Well, and sorry, Barry, I'll give you a turn in a sec.
We'll get to Barry. Yeah. Don't worry.
I think what since February has shown is the energy transition is a transition. As an investor, we weren't thinking 6 months ago that we would have oil and gas and potentially coal stocks in the portfolio. But I think what's really clear to investors now is, when you start to muck around with demand, with supply before you've addressed demand, the implications are higher prices and uncertainty, and that's what's really happened. So I think it's a more realistic assessment now to say that ultimately renewables need to do their thing. They need to become more reliable. There needs to be better battery storage, etc. EVs need to roll out, all those kind of things. But it's going to take time, and it's probably going to take longer than people expect. And in the meantime, some of those fossil fuels, and particularly gas, are going to play an important role. And I think we're starting to see that now.
Yeah, a dose of reality. Barry, your thoughts on 2022 and how we're going and where we're traveling to 23?
Volatility, uncertainty, many cross currents. I think the strength of the US dollar has changed the way people look at markets. The impact on currencies has been very substantial. Now, I'm a long-term bull of the US dollar. I'm also a bull of gold. I think it's really significant that we've seen 50-year uptrends in the yen and the euro broken. Now, that means structural changes. And I actually think that the euro won't be with us for very long. That's just my view. Now, coming back to where we're going, one of the most significant charts that I have is energy demand, broken into OECD and non-OECD. Now, at the moment, non-OECD is about 63% of total energy consumption. And it's growing at about 2 to 3% per annum. OECD has had no growth whatever for the last 15 years. Now, the other really interesting thing is that hydrocarbons, and I don't call them fossil fuels, I call them hydrocarbons, make up about 82% of the world's energy source. Renewables are about 6.5%. Hydro, I don't count as a renewable, is about 6.5% as well, and nuclear is about 2.5%. So if we just put that there and then go and look at major economies and also minor economies, we find some really interesting things. Outside of China, which is about 84% hydrocarbons, and Europe, which is about 80, and the US is about 82. Almost every other economy in the world is over 90% hydrocarbons. Now, if I've had a couple of trips to Africa in the last 5 years, and the number of people who came up to me saying, please, can you fund our coal-fired power station? Because we have no gas, we have no water, no hydro, and impossible for us to get nuclear. And as far as solar is concerned, well, we've got lots of sun, but they're very, very low internal rate of return on investing in solar. Now we come back to another thing. I'm sorry, David, but I see all these fund managers gloating over the fact that there's $4 trillion a year to be spent for the next 20 years on transition to net zero. And they're thinking, think of all the new funds under management we've got. And because we control so much of the world's capital, we can say to the companies where you're going to put shareholders' funds. I think in the long term that's unsustainable, and I think it's fundamentally wrong. Now, yesterday I mentioned that how are we going to do all this when we've got so much government support when the governments are broke? We've got 31 trillion debt for the US, but when we look at the central banks around the world, the European Central Bank has got 84% debt to GDP ratio. Japan's got about 140%, and the US has got about 37% federal debt to GDP ratio. So this basically means that there's going to be very, very significant restraints on government spending. Now, we had a 40-year bull market in bonds. That 40-year bull market's over, and if we look at the last cycle, we had 40 years of bear market in bonds that before they peaked, before interest rates peaked in the first quarter of 1981. So we've got a range an outlook of rising interest rates and a lot of currency volatility. And as I mentioned, I really doubt that the euro will be with us in 3 years' time. Now, if you see what happened with the election in Italy, and when you see what's going on in the streets in France at the moment, and there's big pushback. So there's a lot of political changes to come, and it's making it very difficult to sort of see things going forward. The other thing, am I talking too long?
No. Carry on.
The other thing which is really important is that, and I'm sure everyone noted this, but the BRIC expanded, looking to set up their own non-US dollar, non-euro currency bloc, which will allow them to trade hard assets, which is commodities and manufactured goods, rather than financial instruments. And if we look at the world market at the moment, the global bond market was just over 100 trillion. I think they've probably lost the best part of 15 or 18 trillion over the last 6 months. But most of that's in US dollars. And so the US dollar is really, really important for financial services, plus all the internet-based technologies, which are all wonderful for us. But it basically means you've got a bifurcation in the world between the Indias and the Chinas, the Brazils, Middle East and Africa, that have all got quite good underlying growth components. And then you've got the West, which is basically welfare states, and they're coming to a crunch. Behind all this, which is on a more positive note, is that infrastructure in the United States and Europe has been really neglected for decades. So I can still see a great need for that once we've had not the World Economic Forum's great reset, but another reset coming through. Now that just comes back to the final bit of this little talk, and that's gold. Where does gold fit in? Now, being a long-term gold bull, I'm not a gold bug, I'm a gold bull. I like to think of gold being as a metal of prosperity rather than a metal of crisis. And the real demand for gold comes from India and China and funnily enough from the United States. So the role of gold is being clearly suppressed. I see it in the market. You see programmed trades of gold when you get. I mean, Australia is the second largest or third largest producer of gold. We do about 330 tonnes, and when we see 2/3 of Australia's gold production sold in 2 hours on COMEX, you've got to think, well, that's not a producer. So it's clearly programmed trades. So I think there are a lot of things going on in a political sense around the world which are going to bring a need for an examination of what central banks are doing. Why should central banks be able to push up interest rates and bring them down just to bail out the big guys in town at the expense of Main Street and the man in the street? And then we've got to have a re-evaluation of what gold is and the need to have a gold standard. And I'll just finish on this note that since the abandonment of Bretton Woods, we no longer have a measuring stick. We have nothing to measure anything. So we don't know what the S&P 500 index is because it's only a number. We don't know what a currency is because it's moving up and down all the time. We don't know what GDP is because we're not quite sure which day we're measuring it and which currency and so many other things. So we are going to go back to some sort of gold standard. And I think what's happened with Russia, with the backing of the ruble, with gold, is an interesting step forward.
I mean, on a personal level, the best investment I ever made was putting solar panels on my roof. I mean, literally, the return is fantastic. Let's give David
I'm stuck in the middle a bit here, but the point I'd make is, as an investor, you go where the opportunities are, and clearly, if I'm looking at the market and saying, what are the key resilient themes that I think will perform well over the long term, I think it's energy transition. Now, as you see with a lot of forecasters, where they're forecasting equities or commodities, whatever, people are often wrong. And what you've got to be able to do is be flexible and adjust. So if the demand for those commodities isn't there because renewable demand is falling, then we'll adjust our portfolio.
But I mean, right now, can you actually make money investing in renewables?
Well,
and maybe that's. Yeah. Let me rephrase that. Can you make money investing in the energy transition, and where are the best opportunities?
Well, you just got to look at lithium, right? Don't you? So over the last 12 months, I think if you look at the spodumene price from early 2020, it was $500 a ton. Now about $6,000 a ton. I think the lithium market is a bit unique because it started very small, and so demand sort of outstripped supply very quickly. But certainly, our fund's actually done very well. We see a lot of opportunity. I think you can, and I think you will. Yeah.
And the other thing that Barry mentioned is the US dollar, and in some ways that's quite an interesting thought, especially for Australia, because the last time we had commodity price boom, the Aussie dollar got up to $1.10 in about 2011, 2012, if my memory serves me correctly. Now it's going the other direction. Isn't this a wonderful opportunity for Australia in some ways?
It is. I think it's a very, very important point that you make. And if you look at it, the A dollar on the cross rates against the pound, the euro, and the yen in particular, we've really been outperforming up until the last couple of weeks extremely well. But I mean, the Canadian dollar got smashed last week, and the A dollars sort of come down a little differently, but in the same sort of time frame. But up when we're up around 71, 72 cents, we're at the 100-year downtrend against the US dollar. So when we went through 110 in 2010-11, we actually broke that 100-year downtrend. We've come back, we've gone up, and just unfortunately popped down underneath it again. But I do think that we are going to bounce up and run. There's another. Am I talking too much? There's another really, really important thing. Who knows anything about the South China Sea? Now, look, do yourself a favour. If you've got your iPhone there, get Google Earth out and look at the South China Sea. Just, if you've got it there, do it now. And you'll be amazed, because it is, in fact, a sea. It's not, I always thought it part of the Western Pacific Ocean, but it's a sea. And when you start thinking about China, now I've been following energy consumption by fuel type for about the last 15 years or so, and the BP stats, energy stats are quite fabulous. But in 2004, I went to Shanghai and I presented at a coal conference, and these stats were really interesting, because China in 2004 was 67% fueled by coal. Gas was about 2%. Oil was about 10-11%, and a bit of hydro, and I hope that all ends up to 100. But we had 67% coal. Now the energy consumption growth has been dramatic, and I've always seen China as a long-term gas sink, in the sense that everywhere else in the world we've got about 22% energy consumption by fuel type as gas, and China was 2%, and they're only up to about 5% now. So we've seen dramatic growth, but in a total energy mix, which is energy demand, which is growing. Now there's still 60%, but probably 58 or 59% of that is domestic. So when you come and look at the South China Sea, if you looked at it, you'll see that all the oil that China imports and all the LNG needs to come through the Straits of Malacca, and also the Strait of Hormuz. So you've got all these seabed issues amongst the Philippines, Indonesia, Vietnam, Cambodia, Vietnam, Thailand, particularly the Philippines. So China is very, very concerned about its supply of energy, and you can see that there's no way that they're going to let themselves go below 60% coal. So I see this as a major issue that's going to develop. Now, because Australia is the world's largest exporter of LNG and one of the largest exporters of thermal coal, I know that you're negative long-term on thermal coal volumes. I'm not so sure about that for my own reasons. But there's something that's really, really interesting. Now, if we get our currency back up to 70 cents and we can measure our GDP in US dollars. Now, remember I said, what the hell's, if we don't have a gold standard, we don't know what our GDP really is, depending how you're measuring it. But we're the 12th largest economy at the moment. Now, I think in a couple of years we can be number 9, because it means we jump over Canada, South Korea, and Russia. So Australia becomes a very, very important nation strategically. So I was over at Diggers and Dealers. I'm talking too much. I'm sorry.
Perhaps. But it is kind of, it's always interesting to get someone who's got a completely different perspective to what most people have. And that's quite interesting. I mean, I think, I agree with you on several points. I think Australia is uniquely well positioned to take advantage of the opportunities. It seems, I hate that phrase, the lucky country, because most people don't realize it was actually an ironic phrase. If you actually read the full quote, it's a lucky country effectively run by idiots who don't realize how lucky they are. And that is, quite an interesting thing. But it seems every time Australia trips and stumbles and falls face flat, we've just discovered something else that works for us. So, the renewable energy transition, or the energy transition, is I think, a tremendous opportunity. I always think the problem is, how do you ramp it up at the same time as keeping fossil fuels? I found it fascinating. Yesterday, I don't know if you noticed, there was some guys outside banging a drum. I love people like that, because I always go and ask them, what are you against? So there's a guy banging a drum made with material that came from crude oil, to protest against a mining conference where the people inside the mining conference are overwhelmingly focused on how are we going to transition to what that guy says he wants. But he's protesting it. And that just shows you the sort of disconnect of a whole range of things. Miners are unloved, but are the most necessary part of the energy transition. And I also the problem that people see, and it feeds back into commodities, is right now in Europe, America, even in China and places like that, a lot of people are focused on what I call the end stage of the energy transition. So they're putting in solar panels, they're designing and building electric vehicles, they're building gigafactories. They're switching coal-fired boilers and heating systems to, induction stovetops and heat pumps, electricity things. And they're all focused on that without actually focusing on, what do you actually need to make all these things? So I always think the risk is that we run out. You build all this capacity for the energy transition and then don't have the basic materials or raw materials to do it. So that brings me back to another sort of longer term or sort of question. We've talked about lithium. What would be the other commodities that are likely to go into short supply and where there's not really much new development in the pipeline? Maybe that's one, perhaps, I'm sure you look at that sort of thing, because that's where you think you're going to make the most money.
Yeah, look, I think you're right. And I think the broader point you make is, what is the risk to energy transition? And that is, will there be enough commodities to meet the demand as that demand ramps up? And I think we're already seeing it now where, lithium's a good example, where there's a shortfall. The key commodities we look at are copper, nickel, lithium, rare earths, perhaps a bit of graphite as well. And, I think short term's a bit more clouded across those commodities, demand and supply, but clearly over the next 5 to 10 years, there is an emerging shortfall. And there was a couple of presentations here yesterday, on lithium and copper, and they showed that. And also what they're showing is, where should copper supply be heading, with committed projects by 2030 to be on track by 2050 to be net zero. And we're lagging already. And that's because it takes a long time to bring new projects online. It also is a factor that a lot of where the resources are globally are in unstable precincts, and that's an issue. On Australia, there's a real opportunity because we're tier one, good systems and processes, good regulation, and we've got a lot of the commodities that I think will do well. I think the transition is going to happen. I think it's probably going to happen slower than we want. And there's going to be incredible pressure on commodity prices in those key commodities. I think what we're seeing in the short term is as global economies probably move at best to a slowdown, at worst to a recession, particularly in the bigger markets like copper and nickel, you may well see, prices staying where they are or moderating, which doesn't provide that incentive for new development to get up. So, I think there's some hurdles in the short term, but I think you've got to be optimistic and you've got to look long term, and I think there's tremendous opportunities there.
Yeah, sure.
Why are you less enthusiastic on graphite? Given the sheer volume of graphite that's required for battery anodes,
Yeah.
I mean, it's just incredible.
Yeah, look, I think demand and supply at the top level look great. What worries me about graphite is where the best resources are. Mozambique, Madagascar, Tanzania, and the processing in China. As an investor, you go, are they really the risks I want to take on? But clearly, the demand for graphite the demand for graphite will be there. The other thing is, if you look at the graphite markets, often the premium prices are in the flakes, whereas the battery demand is really in the fines. So you wonder about how, as new projects come on stream, what impact that has on the overall market, because most of the estimates are looking at a blended price. But graphite, there's certainly an opportunity. I'm just not sure the best way to play it as an investor yet. Yeah, exactly.
Another thing that I've been looking at and thinking about is right now, Russian metals is still available in the world market. And there's a very good chance that won't be the case next year. Can the world actually get by if Russian copper, nickel, aluminium kind of disappears from the global system? I don't think it will disappear entirely, but we saw we've seen in the energy markets, Europe is going to ban the import of Russian crude and products from December for crude, February for products, and that's forcing a whole reevaluation of the flows. Yeah. And what we have seen is that while you can redirect some crude and some product, you can't redirect it all. So of the 7 million barrels a day, well, actually roughly 5 million barrels a day of crude and product that Russia supplied, predominantly to Europe, they're still going to be able to sell some of that, but they're not going to be able to sell 5 million. They'll be able to sell maybe 3.5. So you're still looking at a tightening of 1.5 million barrels a day, which is 1.5% of global demand, and that's you see what that's doing to energy markets, and even in coal, it's an even smaller percentage if you actually look at what Russia supplied, and you've seen what's happened to coal. So are we looking at a big risk in 2023 if the LME decides that no, we can't have Russian copper in our warehousing system, or companies self-sanction and say, well, it's too risky to deal with the Russians anymore, so we won't do it. Is that a risk? Is it a big risk? And how worried should we be?
I think the thing that we need to focus on is the fact that if the Russians produce it, they'll want to be able to sell it, and they'll only produce it if they can sell it. I think we'll see a lot sold to India and China, and other countries. They might not be coming into Europe. So I think it will be absorbed on the market. I'm sure there's arbitrage going on at the moment where Russian materials is being delivered into China or India, and other suppliers basically being put back into the market. So, but I think that will balance itself out probably next year. Look, I think the other really interesting point, I was going to say I was over at Diggers and Dealers in August in Kalgoorlie. Did you get to that?
I did.
Yeah. I'm just so impressed with the Australian mining industry in terms of the way the iron ore industry has just made so much money, and the LNG business has made so much money. I mean, Australian export revenues in the June quarter were pushing 500 billion, which is a massive amount of money. That's $8. But I saw a number that BHP paid more dividends than any other listed company, non-government listed company in the world, and it just pipped Microsoft. An extraordinary incredible thing. So it just gives you an idea of how powerful and how strong these major Australian companies are going to be. And I think it's going to be right. It's going to be there with the lithium, which is what you're talking about, Pilbara Minerals and all those players, Liontown project, the way we're going downstream to make the chemicals, Nickel West for BHP making the cobalt and nickel sulfate. So these are they're really, really big companies now, and the discovery of at Julimar by Chalice is massive in scope, but that is nickel, copper, and PGEs. Now, since then, there's been about a dozen new discoveries of nickel, copper projects with PGEs there. So I can see a massive new industry developing in terms of those nickel, cobalt, sulfates, we've always had this problem with our commodities that we haven't been able to do any value add. But I think this is a time when we can take our metals and convert them into chemicals and sell them for a good premium. So it's just going to make these companies and as these emerging companies come through, really very, very significant in the world stage.
David?
Yeah, I mean, maybe going back to the point you're asking, I think very clearly what we're going to see on commodity, demand and supply, nickel, copper, etc., out of Russia is you're going to see a reconfiguration of supply chains, and I think the Russian production will still be produced, but I think there'll be different buyers for it, and you'll just see copper that China was buying from elsewhere will now be bought from Russia, for example, and India and probably other countries that will pick up the slack. So I think in short term, high chance of some volatility, but I think that's where the world is heading, where people are really evaluating who they want to trade with. And as we're seeing with gas in Europe, you want security of supply. So I think that's going to happen across all commodities. Yeah,
it's
got a comment about Russia.
Yep.
I mean, historically, most conflicts end in settlement in the end. So this is either going to get really, really messy, or it'll end in a settlement. And surely that settlement is going to have to include Russia just being inserted directly back into the commodities complex again.
Actually, I'm quite skeptical of that. I mean, I agree that eventually the war in Ukraine will end one way or another. But I don't think, I think this has been an enormous wake-up call, particularly for Europeans. They are not going to go back to Russia. It's like, hang on, you've screwed us once. You don't get an opportunity to do it again. We made a mistake in dealing with you, and we won't deal with you again. And I think that's a very, very determined view in Europe, is that they're not going to, they might buy metals from them, but they're certainly not going to buy natural gas from them ever again. They're never going to put their energy security in the Russians' hands. I mean, that's the message that's coming out very, very clearly, especially from the Germans. The French, they've got their nuclear, a lot of nuclear power in France. And why do they have that? Because they got screwed by OPEC in the 70s and they said never again. So that was, their thinking. So I think, the whole Russian thing, I agree that they will be able to sell their stuff and, supply chains will reorientate. But the other thing that's I think is worth noting on that is what happened when China banned imports of Australian coal. This was a measure that Beijing did to punish us. You're not playing ball with us. We're going to stop buying your coal. What actually happened? Did Australia coal exports fall? No. They stayed much the same. There was a little blip, and then they resumed. What happened to the price? The price went up because by forcing a realignment of trade flows, you actually increased prices for everybody. So in the end, Australia was a beneficiary of Beijing saying, we won't buy your coal. And I fear that that's the sort of thing that can happen with Russia as well. But on the other hand, it's such a huge market that is saying, we won't deal with you ever again. And now the Russians are forced to deal with fellow authoritarians or countries that don't care, like India. So I see the world once again, unfortunately, splitting into two kind of trading blocks: authoritarian countries that deal with each other, Western democracies that deal with each other. I'm hoping America remains a Western democracy. I think that's under extreme risk if a certain person gets re-elected. I think it will move very rapidly into the authoritarian state or split up. That's my big risk. You think the euro is going to disappear? I think America's at risk of splitting if that guy gets back in.
I have a different view on that.
And then your third block is like we used to have the non-aligned movement during the Cold War, people who don't really are just trying to do the best for themselves. And the leaders of that block would be like India and Brazil. But it's quite interesting. I think what happened on February the 24th changed everything. All that we thought before that day, you can forget about, and it's now a new dynamic. And I think we're still working that out. But I think for me, the overall message is it's very positive for commodity prices, and probably for a longer period of time than people expect. You throw in the energy transition on top of that, and if you are really going to change the way the world has worked for 200 years and re-engineer the world's energy systems, and you're going to try do it over a 30-year time period, that's an enormous undertaking. And all of that speaks very highly to commodities. But anyway, we are coming sort of to the end. Is there anybody else who'd like to weigh in? Have a go. I mean, Barry and I clearly disagree on a lot of things, but that's okay. Yeah.
Clyde, sorry, Barry. I thought maybe a point in common that we have, Barry, is the outlook for gold. So it's probably worth just touching on that. So, if you look at gold's performance over the last year, in US dollar terms, it's down about 2.5%. That's against US Treasury yields, which are up 150%, and equity markets, which are down 20%. So, I think it's done its job as a resilient store of value, which is good. If you look at Australian gold equities, they're down about 20%, maybe a bit more, and so I think that there's there's a real opportunity. So, we're bullish on gold. It's always, and gold equities in particular, and particularly Australian gold equities, because there's the exchange rate impact there as well. So, in a period where I think you'd have to say the world's moving into a period of greater geopolitical uncertainty and risk, gold looks pretty interesting. So I think that's really the standout commodity from our view over the next 12 months.
And uranium?
Yeah, actually, uranium has become interesting again. For a long period of time, uranium just puddled along, and now it's interesting.
If we look at supply and demand and deficits and whatever, I think probably uranium is the pick, probably of them all. And when you think of the number of new power stations that are being built, and most of them don't have uranium contracts in place yet.
Well, most of the new nuclear is in China.
Yes.
And yeah, I mean, they will be people who will be happy to buy uranium from Russia and Kazakhstan and places like that. Mm. But that does open the opportunity for uranium in other jurisdictions, such as here in Canada, to get a bigger share. And
I think the other really important thing is that the refining of uranium is really in Kazakhstan and Russia. There's not much anywhere else in the world, and Australia's got to think about this long and hard. If we've got Olympic Dam, which is a major resource, unfortunately it's copper constrained. It's a large resource, low grade, so it's not going to come in large volumes into the market, unfortunately, unless we expand all the copper production. But we really should be thinking about doing uranium enrichment here in Australia, and we could enrich other people's uranium as well. I mean, there's a huge supply risk with Kazakhstan and Russia. I mean, I think Russia still produces about 30% of the world's uranium.
Yeah. This gentleman over here.
My question is to Barry. You say that you are bullish on US dollar and gold. Given that there's a current divergence between the two in terms of prices, Can you explain the dynamics behind what you see? Would
Yeah,
bring
yeah. Look, it's really interesting. I always look at gold. Again, the fact we don't have a gold standard, we've got nothing to measure anything against. So I always look at things like gold against stocks, gold against bonds, gold against commodities, and gold in various currencies. Now, gold's making an all-time high, or has recently made all-time highs in euros and yen and British pounds and so on. And technically, it looks as if it wants to go higher. Now, when we look at gold in those currencies, either the gold price is going up or the currencies are going to go down. So something's about to happen. But when we look at gold against bonds, when we look at gold against, say, the S&P 500, we're about to see a major move against both those asset classes by gold. Now, my view is that the equity markets are okay, the bond markets are due for a rally, and I think we're going to get a very, very sharp move in gold. Now, forecasting the gold price is awful. You never get it right.
It's a mug's game.
It's a mug's game, but it's just setting up to me to be to move very, very strongly now, and I talk about a re-evaluation of the role of gold, and then we're going to get a re-valuation of gold. We just can't go on with printing all this fiat money and thinking you're going to get away with it, because you're not. Now, anyway, I've got all sorts of other views on things. Funnily enough.
I think it was another question.
Yeah, I was going to carry on the same theme. I just theoretically the dynamics between the US dollar and the US dollar index and the metals markets. I mean, can you just go through that again? I mean, I've been trading commodities and metals for years, but are the metals markets being suppressed because the US dollars keeps on going up? And on the other side of the thing, the Aussie Australia itself is making a fortune because of the currency out of exporting the stuff. But it's always been put to us that that the US dollar goes up, the US dollar index goes up. It's suppressing our metals markets. Now, can you just go through those dynamics? So it's never been quite played out theoretically how it's described.
That US dollar index is 57% euro, and it's about 13% yen and 13% Canadian dollar and 10% sterling. So it's really whatever happens to the euro affects that dollar index. If you look at a broad dollar index, and then just look at the US dollar against the Chinese yuan, the yuan under 14 cents, it's got a big drop ahead of it. So when we look at the broad index, it's just about to take off. So the US dollar, in my view, it's not weakening. All the other currencies are weakening against everything because essentially they're fiat. So when I look at gold against all these other asset classes, it's telling me that the gold price is going to have quite a significant move quite soon. And it's going to be to the upside.
Is that because the US dollar index is going to? There is some technical levels you can say where where it breaks down again, but it's not breaking down just yet. But
no,
is it because the US dollar index breaks down that gold will turn with it, and why?
Well, we've got the euro's broken a 50-year uptrend. For the US dollar index to decline, you've got to have a really big bull market in the euro, and I can't see it. As I said, the European Central Bank's got 84% debt to GDP ratio, and the US is 37%. The outlook for the euro to me is terminal.
So saying that, I mean, you just talk everything as far as in reference to gold, but the US dollar, so the US dollar index keeps on going up, but then the gold market's got to go against that trend.
No, it doesn't. I can probably give you half a dozen examples over the last 10 years when we've had 6 to 12 month bull markets in the dollar and the gold price. It's a furphy for me.
Maybe if I can just add, I think you've got to keep an eye on US interest rates. I think particularly what you've seen recently is really the Fed's come out and been very predictive about where, its 10-year Treasury rates are going to go. And I think that's added that last level of support for the US dollar. I think, and my view is on interest rates, the next news is probably positive rather than negative in that, I think they've kind of outlined a worst case scenario, and I think that could change. I think you probably need that tipping point where the market goes, perhaps they've pushed it too hard and it's going to change, and I think that'll be a catalyst for probably an easing in the US dollar and then an improving
That's
in
true.
the
Interest
gold
rate
price.
differentials have been quite the driver of the dollar index as well. It's not just people running for US dollar cover, but it's been interest rate differentials that have led that way as well.
Yeah.
One thing I find interesting when I look at gold is I've always sort of seen it as having three pillars, particularly physical gold demand. What are the three pillars of physical gold demand? You've got China and India, which is predominantly cultural, traditional jewelry buying thing. You've got central bank buying. And you've got the third pillar is what I broadly call the Western fear trade, people buying ETFs because they're worried about other asset classes going down. So when you got gold going up to its record, which again was 2011, when it got above $2,000 an ounce, all three of those legs were well supported. You had strong central bank buying, you had a lot of interest in India and China, and you had a certain level of that ETF Western fear trade, if you want to put it that way. Now, do we have that situation right now? Well, the central bank buying has been sort of steady-ish from what I can see looking at the Gold Council figures. China and India has been recovering, but I'll tell you right now, with a strong US dollar, the price in their local currencies is going up, and that tends to knock their physical demand, and it tends to knock it quite hard and quite quickly. So I'm not sure that you've got that sort of 50% of physical market demand is questionable at the moment. And then your sort of third leg of the Western fear trade, well, again, we're not really seeing that. If you look at ETF flows, they're not saying, wow, people are piling into gold. So I just look at those three indicators and sort of say, well, if I'm going to believe in a strong gold rally, I want to see those three things all working in tandem.
Oh, look, just one other thing, Clyde, though. We've seen a dramatic reduction in gold on the London bullion market vaults and also on COMEX. Both gold and silver has been quite dramatic. So...
I mean, I love gold, but the other thing I also find about gold is when you get together at a mining event and you talk gold, it's a bunch of guys like us, old guys with grey hair, and we love gold and we've loved it for all our lives and whatever. You go to like a conference filled with 20-somethings and talking money. Gold is just not even on their radar screen. It's not something they think about. It's not something they view as necessary. Gold to them is pretty trinkets that you might buy on a special occasion. They don't see it as an investment, and I also think that's a kind of a worry. For a long-term bullish gold case, is the number of people actually interested in gold is shrinking.
in the West.
In the West, yes. That was a Western construct, yes. I mean, it's still very popular in China and India, which is why I put a lot of store in what I see happening in the physical market in China and India. If I see strong buying there, then I'll be bullish gold. I'm not seeing strong buying there. So, I mean, I think gold will hold. I'm not negative gold by any stretch of the imagination. I think the circumstances are actually quite positive for gold. But do I see a strong rally? Not currently. I'll change that view when I see when I see the market indicators change. But anyway, I think we've reached the end, and hopefully that was good fun. Thank you, Barry. Thank you, David.
Yeah, thanks, guys. It's good, and thanks everyone.